is an inverted yield curve a sign of recession? I want to start this video by explaining why, historically, yield curve inversions are so important as recession indicators. We've had a recession every single time the yield curve has inverted, the difference between 10-year treasuries and 2-year treasuries, every single time for the last 4 decades. In 1989, the yield curve was inverted. In 1991, we had a recession. In 2000, the yield curve was inverted. In 2001, we were in recession. In 2006, the yield curve spent time inverted. In 2007-8, we had the financial crisis. In 2019, the yield curve inverted. In 2020, we went into the pandemic recession. Right now, the yield curve is basically at zero, has spent a little bit of time inverted in 2022, indicating that we are about to head into a recession sometime in the next 1 to 2 years, perhaps even right now. Before we explain yield curve inversion and the technicalities, I want to do a little bit of fixed income 101 and explain the Treasury market. The US Treasury issues debt in the form of US Treasury securities, and the investing public purchases them. Currently, there are $30 trillion of US Treasuries outstanding, which means the US government is in $30 trillion of debt. The US Treasury issues different maturities of debt, from as little as 1 week to as much as 30 years. In this video, we're talking about the difference between the 10-year yield and the 2-year yield. These are different parts on the yield curve. Why does the Treasury issue securities in different parts of the yield curve? Because not every investor wants to lock up their money for the same amount of time. Some investors want their money back in 2 years. Some investors don't need their money back for 10 years. That's why we have different maturities in the Treasury market. Yields and prices move inversely. This is something I'm going to do an entire video on soon. But for now, just understand that bond prices and bond yields move inversely. So when rates go down, prices are going up. And when rates go up, prices are going down. Now, how do 2s and 10s move differently from each other in the market? 2-year Treasury yields move in response to different dynamics than what impacts the 10-year part of the Treasury curve. 2s mostly respond to changes in monetary policy and expectations of changes in monetary policy. So for example, when the Fed is expected to hike rates, you can expect the yield on 2-year treasuries to go up. This means the price on 2-year treasuries goes down. The 10-year part of the curve responds much more to investor expectations of growth and inflation over a longer term time horizon, such as 10 years. Now we have to understand the business cycle to understand why 2s, 10s inverts prior to a recession. The business cycle is the driver of investment returns. We have to understand where we are in the business cycle to determine should we be getting aggressive with risk assets or should we be conservative in risk assets. Treasuries oftentimes tell the story of where we are in the cycle, especially the yield curve. And that's why it's so important to pay attention to the yield curve. So what happens prior to a recession? Prior to a recession, you're basically at the end of the economic cycle. You're at the end of expansion. At the end of the economic cycle, usually inflation is running hot and the Fed has to tighten monetary policy by raising rates. So right before you go into a recession at the end of an economic cycle, the 10-year yield is relatively high as growth expectations have been baked into the market, and 2s are relatively low as the Fed has kept easy monetary policy. But towards the end of the cycle, the Fed starts to raise rates. This and the expectation of further rate hikes will drive the 2-year yield higher. Then, because you're at the end of the cycle, the expectation for growth starts to decline. And in that way, the yield on 10-year treasuries usually declines. So you have an increasing 2-year yield and a decreasing 10-year yield. Eventually, that flattening becomes so strong that the curve inverts and the yield on 2-year treasuries exceeds the yield on 10-year treasuries. Now, technically, you can have a yield curve inversion as both 2s and 10s are rising, and you can have a yield curve inversion when both 2s and 10s are falling. But for the simplicity of this video, we're going to assume that 2s rise and 10s fall during a recession because the Fed is hiking and growth expectations are slowing. Once again, to recap, every single time we've had a 2s, 10s yield curve inversion, we've had a recession follow within 1 to 2 to 3 years of that inversion. Right now, we are in a period when the yield curve has just inverted, which means we are probably before a recession. It could be happening right now, or it could be happening over the next 1 to 2 years. We'll have to wait and see. I want to thank my sponsors, Zebedee and Voltage. Zebedee, providing payment solutions for the gaming industry powered by Bitcoin's Lightning Network. Download the Zebedee wallet for a great first Lightning Network wallet. Voltage, providing enterprise-grade Bitcoin and Lightning Network infrastructure. Go check out Voltage if you want to spin up a node with Bitcoin and Lightning Network for your business.